Welcome everyone, and thank you for taking a look at the 144 perspective on using the Fibonacci retracements. I've been using the Fibonacci retracements for over 40 years in my analysis to high net worth traders, hedge funds, and on the 144 platform that provided real-time support and resistance for futures markets, and soon to be on the Iris platform in the Leader Hall. My belief is to keep it simple, and with a few basic rules and guidelines, you should have a greater understanding of any stock or future market's movement. With the guidelines, you will know what to look for when the market holds a retracement and when it doesn't. You'll also see how important it is to know where the market is on the monthly chart, even when you're trading short term, and which retracements are more important than others. In a minute, I'll take you through the S&P futures contract from the inception of trading to the current price on all time frames to show you how the Fibonacci retracements are the underlying structure of all markets. There's the basic four key retracements: 23.6, 38.2, 61.8, and 78.6. These initial rules are short and to the point. The deviations from these rules will also be covered on the free 144 blog that I will take you through after the S&P example. The most important of these is 38.2%, and that gives us the 144 golden rule. Any market that is going to continue with the current trend must hold this level. A subset of guidelines, which with the 38.2 level, are when the market fails to hold this level and when the reaction from it either fails to make a new high low or makes a slightly lower low or higher high and gets right back above the previous high low. Next is the 23.6% rule. And this is extremely strong or weak markets will only go 23.6% back. This retracement level is not for small ranges. And on another note, when the markets have reacted to 23.6 and failed to make that new high low, it is rare that 38% is going to hold. It can, but it's less likely. 61.8% rule is whenever the market holds 61.8 of a move, look for it to go 61.8 of where it just came from. And lastly, the 78.6% rule. Any market that hits 78.6 should go 78.6 back the other way. Basically, same thing as the 61.8 rule. When a market does react to 78.6, it usually creates wide swings that go through all the other retracements. This either happens in very large trading range or very small. It is also the level hit most often when the market is reacting from 23.6 and 38.2 and fails to make a new high or low. Okay, now we're going to show you why exactly we feel that the Fibonacci retracements are the underlying structure of all markets. To start here, we'll go back to the monthly chart, and we have to use the S&P futures from its inception. And as we max out here, I just want to take you through the very beginning in time here of what is happening and how this market has moved. And you can see each of these layout shaded areas were all retracements, just right from the get-go. So we have here, it's very hard to see, but it's 38 back. Once again, we just take this retracement up. We see that this setback here, 23%. Then we go and look at what happened in the 87 crash. And you can see that this thing went right down to 61.8 before it resumed the uptrend. Now this stuff just happens again and again and again, and you're just going to see it as we go through this. So here we go with the new highs from the all-time low to what then was the all-time high. Again, holding 23.6%. Now again, we've been saying in here, and you will see in our website that the rules and guidelines are any market that is extremely positive is going to hold 23% of the current trend. And in this case, you see it here, and should go for new highs. Now, the market gets so far away from itself, or just takes off, that it gets so strong that you can't even go down here to retrace, that you have to come up and bring in new retracements on what to watch, and that would be even tighter levels. So if we go from here and we look, that not only was that 23% back to the all-time low, but to the crash low in 87, it was also 38%. You'll see a lot of that. One thing to always watch out for, if there's a spread between them, you always want to go with the bigger retracement. The retracement meaning a much bigger amount in price. So now we just have to go, and you just see that this market's so strong, we have to even come back to here to get anything, any semblance of some kind of retracement. Once again, 23% sets back, and the explosion continues. Now, as we go on, we can see here that, let's see, we'll just get rid of that. And you can see in here, we take this retracement here, and what do we have? We've got to the 87 low all the way back to the all-time low, 23%. Right here, what should we expect? New all-time highs, and that's exactly what we did get. Now you come up to here, and you start to see things that start to change. And this is the first one I want to show you, as far as when a market goes 38% back and doesn't make a new high. That's the first sign something's really changing. And in this case, we look at it here. We see that this spike high came back down to 38%, failed to make that new high. And whenever this starts and you start going the other way, then you start taking the retracement the other way. And you have to watch just to say, well, if any market's going to continue going down, it should stay below 38% then, right? We took it out up here. We start watching it from the low. So 38% back up. We had a spike above it, but the effect, and this is another thing we want to talk about, is that even though you may be stopped out on your original position at that level, you still have to watch it, because the result is going to be the same as if it held perfectly once you get back below it. So here we have the 38 back, new lows here. So we again take this down to here. Where does it go? 38% exactly back up to the high, which was the all-time high at that time. Now we just carry on here, and we see that we're going to have to bring in 23% retracement on this one, that we go right here. Okay, this is another thing. Just as you saw the 38%, no new high, change in trend. Again, same thing can be used with 23%, and that was, it hit it exactly, failed to make the new low, and the trend changes. Now this just repeats again and again and again. And it's why, as we said, the underlying structure. So we start looking back this way because we've changed the trend back up, 23% setback, still a dynamic market. So we start coming out here, and now we can't even get back. That moved wrong. We're not even getting back to 38 of that, which then brings you all the way into taking all the way up to here to get anything to look at where the market sets back. So here, 38% back to this, next most important level here, 38%. Now we get to this next turn up here. And again, this is just going to show you, once again, what we're talking about, the market telling you it's ready to turn. Okay, the failure of it, 38%. We hold this thing here on this major move up. What does it do? Fails to make a new high, telling us the trend has truly changed. And so down they go. There's other things in here. There's 23%. So let me just get rid of this one. And we keep going. Now I'm going to take you down to this 2009 low, and then we're going to go to the weekly chart. So when we zoom this thing out and we look, you just see this thing falling off a cliff. And this is why it's so important to have the history on this thing. At this time, you're going back to 1982 on it, but it matters because that was the all-time high, that was the all-time low. The crash low in 2009 went 61.8% back. Like I said, this is just going to happen again and again and again. So there we have that, and we've seen how holding the retracements, what it means, how holding it and not making new highs, how it reacts. So now we'll take that 2009 low, we'll go to the weekly chart, and we'll look at this. So this is the 2009 low. Once again, we just go back and you see that the market's turned from that 61.8. It's just this is 38%. This one is 38%. This one, again, 38%. Every one of these setbacks is just coming right back into the levels. Now we can just keep on going with this, and this is the thing where it's like fractals. It's what's happening in the bigger picture is happening all the way down on different scales, and we'll show that going to the daily and then into the 5-minute chart. Now, there's, like I said, at times you're going to get where you have to start from even here to here to get 38% of that. But it's this because this thing just becomes so dynamic. And again, you can take it down into even the hourly chart, and you're going to see the exact same things replicating. So here we go. What happens here? Market's solid. The 2016 low. What is it? It's right back to 23%, and just takes off again. Telling you the market's just so dynamic. Then we take it all the way to here. Now here's again going back to if you bought it here, you're stopped out. There's no doubt. That's crazy money here if you're risking that kind of stuff. But the point is that once it gets back above there, the rule and the guidelines are that they should then go on to new highs. And that's exactly what this thing did. So now we're all the way up to the 2020 high. Okay, now we'll show you one thing here that, again, you see here, 38% totally destroyed in this movement. This is just obviously, the latest crash, and it's just wicked. But the point is, you can be stopped out, and this was almost 200 handles through the level, but it was one day that closed below this level and then right back above it. Now, this is why you've got such a dynamic move up, because of what you hit here. Now, another reason, and I'll show you, and I'll go back to the monthly, is just why this was so important. And like saying, getting under it, getting back above it, it takes off. So let's go back to the monthly right here and take the bigger picture and get all of this in. Whoops. Get it all the way back here, and we go all-time low, all-time high, 38%. Missed it by a bit, but you knew that this is, holding above, holding it, or even trading below it, getting back above it is still, what are we looking for? We're looking for new all-time highs. And this is just another reason why, you look at all of these spikes that were lows came right into major retracements. So now let's just take this on the daily chart, and we'll go from here. Now, this move up to the all-time high, again, You know, look at what's happening here. You know, we're staying above 38% right here. You know, bring it back up. We're hitting 38%. And here's another thing that's going to happen. You're going to see this market stay inside of, you know, an area where it didn't violate anything. It didn't make the new highs yet, but the effect is still there, and you have to watch that. In fact, this setback here was exactly 61.8 on this one, and then we finally break out, and then you start seeing from here it's 23%, 23%. Now, this doesn't look like much right here, but this is almost $200 worth of movement, which in any time would be a huge move. And as soon as that 38% got out, was taken out, you knew the trend, the move is over at that point, or the high is in for the time being, until you can find some other level that holds this market. Now, as you see, we blew through everything, through here, through 38. You have 50, but we're not going to be concerned with that right now, because what we're then going to watch, because this trend changed, we're going to take this back and we're going to go back here. Now, once again, even though it went to the 50, there was one day that it closed up above this 38%, because that's what we're going to start watching once the trend changes. Okay, so we got that move, and then where should it go once it closed right back below it? Close above, close right back below. So we know we've got the high. We start putting this thing back down, right? I mean, come down here, and let's go all the way to the low. That now we know this low, what it was. It was 38 back to the all-time low with the all-time high, and it had violated 38 back to the 2009 low, but had one close below it, got back above it. So now we have to start watching the other way. So what happens? First left we hit is 38%. Now here comes another basic rule on this, and that is that anytime 38% of a big move can only take you 38%, which they never close below here, is telling you that even though you think the market should be going for new lows, to hold a 38 of a smaller move is a very positive sign. And so now we take this out and we start watching the retracements from the 2020 low. And here we go. So we knew this one was in the 38 range right there. Then we come up here, 23%. This just keeps going on and on and on. Right here, 23%, a dip down below it. These things, it's just that dynamic. You just have to keep watching this, and you will see it. As soon as the trend changes, you have to start watching them from the other side. And here we are now right up to this Friday, where we just have taken off. But each one of these key levels, it just tells you the direction of the market by what is actually holding, and why you blow through other levels when, you know, you're saying, well, what about this rule or that rule? And you know, well, you have to use them all the same. And in this case, that, yeah, we hit 61.8. We should have been looking for 61.8 the other way, but that doesn't mean we don't watch all of the retracements. And in this case, you just start to see it coming back into these. So now I'll just take it into the last thing, right down into the 5-minute, which basically could be the 1 minute, but I just need to fit it on the screen here. So this was the 30.87 low just the other day, and now we just take this thing again, and you're seeing the exact same things happening. What are we holding here? 38% right here. Okay, market continues to rally. Where does it go? Okay, now we get a combination of not only this, but of retracement from the secondary low. So right in here. So we've got this thing again where it's telling you, this is the support in the market. And these are where it just keeps coming back to. Now we know we have this low here, and I'll take this one out, and I'll go to the 1 minute just to show you this last bit here. And that is that this is the low that we were talking about right here, that we now start retracing from there. And we see it even on a smaller scale, that if we go from here to here, we're at 38%. I mean, at 7:53 in the morning. And, the next thing you know, we're new highs. And it doesn't matter what the scale. This is 1 minute that we're down to now. We've seen it, 23%. Same thing there. Now we look at this and we see that, it hits 23%, sits around here for this long. And again, you got to go out to the longer term things. So let's go back to the 5 minute, and we take this retracement, and you see where the end of the day happened on Friday, what it went down to, and right there, 23.6%. We tell you, if you follow these basic rules, and you will be able to trade the markets with much greater confidence. A couple last notes before we go to the 144 blog. When you feel nothing is working, it is most likely you're dealing with too small a view. When this does happen, go back out to the long-term levels and work yourself back down. When the market is caught between two major levels, they can be both retracements or a retracement and an all-time high. This is the time to watch for 61.8 and 78.6 levels, as they both cause wider swings in congestion areas. But always be aware of what should still happen from the last major retracement, even when they are in the congestion phase. Even though a retracement may be saying you should go for a new high or low, you still have to watch all the other retracements in the new direction to just see how weak or strong the market is. Lastly, when we talk about taking out a retracement and then getting back above it, we want to see this happen very quickly. So if it's a daily chart, one close below it is acceptable. It should always look like a spike, as you have seen in the previous examples. Now on to the 144 blog here. As you can see, we have down below, we have all of the updating ideas we have within using the Fibonacci retracements and some other things in all kinds of different markets. So it's just a continuing learning experience here, just even reading our current updates. So, but here's where the learning does continue, and that's under Fibonacci Guidelines. So if we click in here, again, the rules come up, and you get the extended rules. And what is really nice is that you can go under here and look for the charts and examples. So now, again, the rule comes up, but then we go here and the euro currency update to January 13, 2020 post. Now, what we'll do is we'll go over everything that's happening in this chart. You can click on the chart, bring it up, and all of these markers on here and what is happening is exactly what we're explaining down in here. So this just becomes another place to see it in action and get a greater understanding of what is going on. So now we go back, and that was the 38% rule. Again here, 61.8 explaining what it is, and then click here and we get through and we go into all of our examples once again. A trend change that leads to a 61.8 trading range. In this case, it's the DAX as an example in what's happening. So you can scroll through here and just keep going. And again, it's we cover all of the 4 basic rules, and then some additional guidelines here. So we hope that this has shown you the importance of the Fibonacci retracements, and that you will take advantage of the free blog with more on the rules and guidelines, along with the continuing examples and updates on how to put them in practice. Thank you all once again for taking a look. And all of these charts are provided by Barchart Trader.